Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at Thursday's market trade action, lower tones across grains and livestock. Here to discuss it with us, we welcome in our good friend Bryan Doherty, Senior Market Advisor at Total Farm Marketing, joining us today. Bryan, good to have you on the show, sir. I hope your week is going well. Better in these markets on Thursday, mostly lower across the board, it looked like at the close.
Yeah, pretty tough session again. When you look especially at, I'm going to start maybe with the livestock, just kind of a real test of the bulls today with cattle down quite hard. And you got a winter storm moving through. You think, well, maybe that's going to get some of these bullish traders buying these dips fired up. It didn't really seem to do that today. And not that this is a drastic, snow event, but it's snow and it's rain, it's mixed temperatures, give or take, that freezing mark for a lot of us, and probably just not ideal for cattle. But no, down day nonetheless, a little bit concerned. Really, it's just on the demand side. You look at some of the economic numbers, not real great. Look at the Dow Jones as an index or the S&P or any of these. They've been under pressure lately, down again today, 33,200 on the Dow. And 3 or 4 days ago, we were 34,500. So, again, kind of another squeeze play on the economics, but more so maybe a little concerning for the livestock and grains in general. Just kind of the confirmed weak data out of China. And just, other things you're hearing. Hog prices in China down 50% apparently where they were, and, encouraging their producers to cut back. Just seemed like yesterday was they were building their herds to no end because they were so tight and wanted food security. So a lot of mixed rhetoric out of that part of the world, but looks like more of a risk-off day right across the board, whether it's equities or commodities. And that includes, with the exception, but the energy markets were really all over the place this morning. Now they're back higher, but yeah.
Yeah, well, and I made this comment on yesterday's show, looking at how it felt like this hog market with all the volatility there's kind of at a boat anchor on this cattle market a little bit. Now today, more of that risk-off sentiment, but you mentioned quite a few of those things, the economic data out of China, the demand concerns, et cetera. Plus, too, I know a cattle on feed report coming up tomorrow, so I'm sure that's weighing in. It feels like there's a lot of dynamics, a lot of news items weighing into this protein sector, but I'd like your thoughts on, do you feel like maybe this hog market's been a bit of a boat anchor on this cattle market, considering everyone still seems to be really bullish this cattle market?
Well, you can't help but come to that conclusion. If I take a look at just as an example, I can pick any contract, but let's just pick the May hogs, around 93. They were just under 102 at the end of December. That's, big 10% down here in January so far. 10% down on hogs is going to be an anchor on something, that just not hogs themselves. So, are these forces that can kind of help to clear extra supplies or whatever you might call it, get the consumer more fired up perhaps? But I would just argue that it's not just hogs. You look at the milk market down a lot and continuing to look soft, challenging now the $18 mark as a potential bottom, maybe push under that. We were under 18 to 17.94 on the March contract earlier today, and that's a new contract low. And you look back to where we were in the fall, we were at $21. And it's one of those markets you talk to producers in fall, and 21 wasn't good enough, and then they didn't want to sell in fear it would go to 22, 23. Here we are, sub 18 or right at sub 18, and no sign that the market's done going down. Maybe oversold, but no sign it's done going down. So we've got those issues. But the dairy industry, we did see some herd build up a little bit, but more efficiency. We talked about that before. More milk per cow, a few more cows. But the backdrop of us let's call it a squeamish world demand market is behind all of this. And the money is just not comfortable buying, even though it's cheaper, it's not buying when it looks like consumers are kind of pulling their wings in right now.
Well, and thinking about the economic data we've seen, and you mentioned consumers kind of pulling in their wings, we've gotten the consumer price index and the producer price index both on the surface signaling maybe a cooling of inflation, but one has to wonder if you really dive into those numbers, Brian, and look at the economic sentiment, the news out of China, how much, if at all, is inflation truly cooling on us right now?
Right. So there's a lot of dynamics, and my level of education ended at a 4-year degree in agricultural economics. So I don't have one of these high-level master's degrees where you do all these econometric models. And then I was at a conference this weekend, and the economist there, he's from the Chicago Mercantile Exchange, Eric Norland, extremely bright, very worried about world economic conditions, but he also kind of started out saying economists are notoriously wrong. So, so, so you work with a set of variables and whatnot. So, anyway, the point of it is that things do change, and we're just in an environment right now where when I read a headline that says the tech sector or somebody in the tech sector is laying off 10,000 people, that's a lot of people. That's a lot of stuff. So, you counter that and go, well, geez, why are things inflationary if companies are laying off? So let's see what kind of unfolds here. I think we're into some somewhat uncharted economic territory where we're kind of seeing. I grew up in the 70s. We're seeing stagflation at that time, where you saw inflation and poor job layoff. It's odd. So we're seeing a lot of things that may not be quite business as usual. And we were so used to, for a long period of time, sloping downward interest rates and then steady inflation. Now we got higher interest rates, increased inflation. I think the backdrop of all of it was, without getting too deep in the weeds, and I'm a reader and a listener, but if I could regurgitate, too much money supply into the system to try and keep things really moving through the whole COVID window, and then probably stuck around with too much money and pumping money into a system when COVID was on the retreat, and you end up with a lot of excess money chasing goods, and maybe chasing goods and services, and you get this environment here where all of a sudden you blow things up, and now companies are finding it difficult to make profits when you're paying more for labor and more for all your inputs.
Very true. Very true. Well, I know this conversation parlays itself into the grains as well, Brian, and I know there's other factors as well to look at the grain trade. Looking at how things wrapped up Thursday, beans and wheat, downside leaders, it looked like corn down a little bit. Walk me through, since the last time we talked before the USDA numbers came out last week. So now that we've got those numbers out in front of us, you look at things, you look at how this market's reacted the last couple of days now. Do you think the euphoria from those USDA surprises is past us? Do you think we've digested that in these grain markets?
When you have bullish numbers, you get some sort of reaction, then you digest it, just as you get bearish numbers, and then life kind of gets back to normal, but you have a new set of numbers to work with. So we've got some tighter supplies from, I think, expected. The big one was in corn, I think. This conference I was at over the weekend, one of the economists there said it was I've never seen anything unfathomable that they would lower acreage in January. Never seen anything like that, but they did. It makes a little more sense that corn acres were cut, in the sense that why is basis so strong in the Western Corn Belt? So going into the report, I think you and I might have talked about this. I had indicated I just don't know where there's surprises, and we went through kind of the line items. Probably not in feed, probably not in ethanol, probably not in export. So they might cut the export number, which they did, a big number, not an incremental change, a big number, and then they cut likewise on the harvested acres. So in the end, you didn't have much of a change in carryout. So the new number is no change, which is considered positive, or was by the market, because I think everybody's bracing for some type of increase, 100 million, 200 million bushels of carryout in corn, and same thing in beans. You just didn't get those increases there. On the other hand, the market then focuses attention elsewhere, what's going on in the Southern Hemisphere. So favorable numbers. When you look at the Southern Hemisphere, sort of this big machine in Brazil marching forward with crop potential and crop prospects and countering some of the potential in losses in Argentina. And so far, kind of a net on that. At least that's the way the market is, and it's really at a standstill. So here we are again, down 2 days in a row after 4 consecutive higher days in corn. March corn at 677. This is getting a little boring. We've been at 677 every month since August. So we're just trading either side of a range, waiting to see what happens in South America, what happens to inputs, what happens to the U.S. farmer, what happens to the energy market, what happens elsewhere around the world. Most of those elsewhere around the world variables have probably been slanted a little bit negative for price.
Bryan Doherty, Senior Market Advisor, Total Farm Marketing, our guest here today on the show. And Bryan, we look at the tight numbers from the USDA reports and the market reaction that we're discussing. Old crop versus new crop. Are you worried more about one or the other with downside risk potential at this point as you look at these charts and look at the market as a whole?
In the long run, I'm more worried about new crop. In the short term, old crop is holding up enough that I'm worried about that. So if you're a farmer that has a lot of inventory of bean and corns, you've kind of got your second life and your second chance to sell, into levels that were resistance points before. Now, 685 is where we hit this week on corn, or a little bit above that. Back in October, we were $7. This is based off the March contract.
Mm-hmm.
A lot better than the 635. However, I was going to say we really need to see the export market pick up. Well, I don't know what's holding prices up if we don't see. You still got to use the stuff and sell it, and you can keep cutting. Now that the potential bull scenario that might be developing is that if Argentina struggles with production, and let's say Brazil does on their second crop corn, let's just say the USDA has made some pretty big cuts to demand on the export front, so they might have to backpedal and start pushing those numbers back in. Or what will happen is you'd really start to see end user buying aggressively pick up.
Mm-hmm.
And we're seeing some here from Egypt, Algeria. I think Algeria was one of the others. We're seeing some countries kind of step in front of this and buy after the USDA report, but those still are not game changers. The game changers would be South American weather. Right now, it's not adverse enough or perceived adverse enough to sustain a rally at current price levels. These are high prices.
When it comes to new crop, if I know the cost of my inputs here at this point, mid-January, it's just, I know we've talked about this ad nauseum as well, but it really makes sense now considering there could be some downside potential here with new crop prices to maybe get some floors locked in if you know the cost of your inputs, et cetera. I know it's a case-by-case basis, Bryan, but just with that downside risk out there, folks got to start managing it, it feels like to me.
Absolutely makes sense now. And if I talked to you last year or the year before, it might not make any sense. It just depends where the market is relative to what you think it costs to produce, and then relative to what the market may go down to if we have increases in production. And right now, there's we're talking the market hovering around $6 on December corn. It's not 677 like March corn, so it is discounted already. But how long do you wait to see if you can't pick up some ground, or wait to see if March falls down or the next front month falls down? The wheat markets looked rough the last 2 months, 3 months. That's your leader right there worldwide. Who buys wheat? The whole world buys wheat. They're not buying wheat. They're probably not aggressively buying corn. So make note of that. Make note of the idea that it is now January 19th. It's not December 19th. We got another 30 days under our belt. We got to look at the Southern Hemisphere. We get a little bit more feel for it. And we've got a little bit more idea what the money flow looks like compared to where it did 30 days ago. So we're getting more information. But the bottom line is, this is, you'd have to have, Clydesdale horses hook me to a chain and drag me across the fairgrounds like the wagon fell apart or something to tell me that we shouldn't be protecting value on a third of this crop or 25, whatever number you're comfortable with, and let that either be your anchor to pull up prices you're selling at later because the market went down, or let that be a bit of that'd be your pulley. It's going to pull your prices up, or let it be an anchor against some higher prices, but you can live with that. You're going to be in a farming operation that is making money, assuming normal yield at higher prices. But what happens is that for a lot of guys, it's just tough to get started.
Mm-hmm.
So I'd like to say, well, get tough and get started. And if it goes higher, you can, the idea is to average up and sell more. And I hear the arguments already, people going, well, what if I have a smaller crop? What if I have this? Well, let's assume you're going to have a normal crop, worry about the smaller later, or that's what's insurance for. But
Mm-hmm.
what happens is prices often do rally, and people will be, well, that was, would have been the wrong thing to do, but I'm going to sell some now. So they sell some now, and then it falls apart, and then they don't sell anymore, or maybe it's a little bit more. So when you kind of put all those numbers together, usually the guy that sells early and then sells often and sells higher gets more in place than the guy that waits to sell some higher. And then when it falls, sometimes it falls so quickly, you just can't get more done.
Very good points there. Bryan, before we wrap it up today and before I let you go, any other final thoughts you want to share with us here on the show today?
No, we covered them. I think the last thing we covered is the most important thing right now for grain producers is to really be paying attention. So that's where at the beginning of the show, I was thinking about, how do we end this up?
Mm-hmm.
Ended up with, prices could be on a slippery slope. $14 beans, all of a sudden have been fixed $13.64 beans on the futures. December corn, 605 is all of a sudden 596. We don't want 596 to become 575 and then 550. And so think about ways to defend that. If you have questions on that, you can always connect with your advisor or connect with us, connect with me. Happy to talk you through it.
Well, and Bryan, if folks want to connect with you, what's the best way to reach you?
I would prefer a phone conversation. 800-334-9779 is the first thing. And then shoot me an email, Bryan with a Y, BRYN, at totalfarmmarketing.com. And if you just want to look at resources and things available, check out our website, totalfarmmarketing.com. But give me a personal touch either through phone call or email, and then I'll make sure that we get in touch with you.
Fantastic stuff as always. Appreciate the insight with that. Bryan Doherty at Total Farm Marketing. Have a great one, sir. We'll talk to you again next week.
Yes, sir, Jesse. Thank you, and you as well.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.